From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, March 24th, and welcome to another episode of the Macrocast. I'm your host, Ylan Mui, a managing director here at Penta, joined as always by our friends Brendan Walsh and John Fagan from Markets Policy Partners. And this week, we're going to dive into the latest on the Federal Reserve's interest rate hikes and the implications for the economy. We'll talk about the ongoing turmoil in the banking sector following the collapse of Silicon Valley Bank. But first, I want to say that this is a very special Macrocast for me because it's my first time joining as host of this podcast. So thank you all for having me.
Welcome.
Yeah, it's great to have you in the driver's seat.
Yeah, so just a little bit about me for our listeners. I joined Penta about a month ago as managing director, but I spent about 20 plus years, depending on how you count before that, in journalism. I was at CNBC as the congressional correspondent focused primarily on fiscal policy. Before that, I was at the Washington Post writing about monetary and economic policy. So I covered the Federal Reserve under Ben Bernanke and then under Janet Yellen, now Treasury Secretary. I covered the Great Recession. I was there during the financial crisis. I covered Elizabeth Warren when she was just a Harvard Law professor before she was the senator that we all know and see now. So I've been in this arena for a long time, but I'm excited to have my first rodeo here at the Macrocast.
It's fantastic.
She was actually John's Harvard professor.
And a formidable professor she was. So,
Great. We all have a long history here on talking and thinking about these issues. So we'll just go ahead and dive right in and start talking about the Federal Reserve's rate hike this week. The Federal Reserve raised rates by 25 basis points. You know, there had been a lot of speculation that maybe they would do 50 basis points. Then there was a lot of speculation that maybe they would not raise rates at all. You guys had been pretty consistent in saying that you expected a quarter point hike here, and that's exactly what we got. So what do you think went into the Fed's decision here? Why did they decide to continue to plow ahead?
Yeah, I think it's a very difficult position. Everybody acknowledges how hard a balance it is to strike for the Federal Reserve here. And so, you know, I think that they were trying to adopt the Hippocratic Oath, right? Do no harm. And when you have obviously, you still have elevated inflation. Some of the inflation numbers came out in the most recent readings with a little bit more encouraging progress in cooling, but still well above target. The Fed, in most of its, pre-blackout period commentary, was very hawkish and focused on fighting. And so it would have been a major, departure from their commentary and posture if they'd refrained from hiking at all and gone on pause. And so 25 basis points seemed to be like a very good, kind of middle of the road, right down the fairway, not going to freak anybody out, and was in line with where markets were pricing it to be. And, accompanying that, we expected, and the statement in Fed Chair Powell's presser really did seek to give them sort of maximum flexibility on a going forward basis, and without ringing alarm bells about the banking situation, trying to characterize that as contained, idiosyncratic. Of course, they're going to, acknowledge that there are risks, and this situation could result in a tightening of financial conditions, which they would respond to. But it's, meeting by meeting, will be responsive to the data, et cetera, et cetera. And the markets actually took it pretty well, I think. And, there was some crosstalk, I think, from U.S. policymakers right there that we can get into a little bit. But in general, the Fed kind of did what everybody expected them to do.
Yeah, I thought it was interesting, though, and we'll talk about some of that crosstalk later on in the program today. But I thought it was pretty, candid for Powell to acknowledge that they thought about not hiking. They thought about a pause. They considered it. They discussed it. But ultimately, they decided not to act. And ultimately, they decided that their, mandate for price stability was stronger or outweighed their concerns about financial stability. And the Fed is certainly not the only one who is making that very tough call. We saw the Bank of England move ahead with a rate hike. The ECB is continuing to forge ahead as well. Brendan, how are central banks sort of trying to weigh these different risks, and why does it seem like everyone is making the same call here?
Yeah, I think so. These last meetings, it really came down to what the market was pricing in. They were allowing you to do the 25, but the meetings really came down to the communications over what the future was going to hold. And I mean, you just look at the bond market, 10 years down, another 10 basis points today. The market is, kind of saying, okay, we allowed you to hike 25, but we probably think that's a mistake. And we think that you're going to have to be cutting in the second half of the year. It's very interesting, too, because now we have this like mini banking crisis where at a minimum, I don't think we have a banking crisis either in Europe or America, but we kind of have a confidence crisis. So banks are going to be lending less, especially small and mid-sized banks, no matter what happens for the next 6 months. And that's really the kind of the lifeblood of the U.S. economy, especially for small, startups and things like that. So irrelevant of what the Fed does with their rate hikes going forward, they have slowed the economy massively by what, not necessarily what they did, but what has happened is going to slow the economy massively.
Yeah, conditions are getting tighter even if the Fed does nothing. And
exactly.
It seems like Powell.
It's going to be harder to get a loan going forward for the next, whatever. We'll find out how long that lasts, but right now it's going to be hard to get a loan.
Yeah, and it seems like Powell kind of acknowledged that in his press conference when he said that, the financial conditions are tightening. Goldman Sachs put the tightening of financial conditions at roughly worth about 25 to 50 basis points. Do you think that's the right amount? Or do you think that conditions could actually get even tighter and obviate the need for the Fed to act even more? I mean, is that why the market's saying the Fed's going to actually have to end up cutting because conditions are going to get so much tighter than the Fed anticipated?
What worries me is basically all of our job growth for the last year has been in small businesses. It's startups, like very small businesses. And small businesses get their loans from small and medium-sized banks. You don't go to JP Morgan to start, a food truck. You go to, Chevy Chase Bank. And that's going to slow. So that definitely worries me. The strength that we think we're seeing in the job market might, kind of flip very quickly. And while the Fed is fighting inflation, they might have just created a very deflationary environment.
That's a really interesting point, that the job growth has been among small businesses, and those might be the ones who are most affected by this crisis of confidence that you're talking about. Do you all see that? Do you think the crisis is over? I mean, we're seeing some volatility in big banks now as well, Deutsche Bank, obviously, Credit Suisse, et cetera. But do you feel that the banking system is sound and resilient, as Powell tried to emphasize during his comments to reporters?
Yeah. So John and I were talking. I'll throw him to him for Europe, but it is kind of amazing that a pretty poorly run U.S. regional bank is causing a global financial crisis.
Yeah, he went out of his way to say the Silicon Valley Bank made uniquely bad decisions, right?
Yeah, because this wasn't about assets. It wasn't about bad loans that they made. It was just about kind of quality control of their balance sheet. But I don't think we have. I think the what they have put in place, where you can go to the Fed with your treasuries and they'll loan to you at par. I think that solves the problem. Now we're kind of having a social media markets freaking out crisis, but it's still very orderly. We're not seeing massive flows out of massive deposit flows out of banks. So I think we'll make it through it. But John, kind of what fascinates me is that this has creeped into the European sphere, and I think a lot of it has to do with how regulators are handling this.
Yeah, I mean, you hear some commentation, some commentary rather from EU policymakers that this U.S. banking crisis has somehow infected their banking system. That's pretty generous to the EU banking system, which has been it's really failed to recapitalize some of its major banks when times were good, and deal with some of the systemic level problems that have been lurking under the surface. And these are far from unknowns, right? We saw Deutsche Bank teetering on the brink of collapse as recently as 2016, and the absolute black box kind of conditions of their derivatives book and their capital stack not looking particularly healthy. That and Credit Suisse obviously went to the wall first, but it's far from alone over in the EU. And I think when we talk about the way in which central banks are orienting themselves toward this, the EU has been pretty far to the extreme in trying to separate out their monetary policy settings from their financial stability activities, and to the extent that they hiked 50 basis points at their last meeting, and the hawks of the ECB have still come out. We saw the Bundesbank president, unsurprisingly, I guess, talking about how more tightening is needed, even as the banking giants in his own backyard are wobbling pretty significantly. We're seeing a lot of pressure on Deutsche Bank this morning, and the credit default swaps, which is the cost to insure their debt, both subordinated and senior debt, is widening out tremendously. So this is not over. There are chapters to be written, and policymakers, if you look at Fed fund futures and the way that futures markets are oriented, these are saying that the Fed is going to be getting into the cutting business, cutting rates as early as June. I mean, this is a very dark outlook that the Fed fund future.
We're almost in April, so it's not that far.
Oh, yeah. By December, it's now pricing in 100 basis points of rate cuts by December, which is extreme. I mean, we've seen this neck snapping. We were talking yesterday about this, everybody was on one side of the boat, and it sort of started to tip, and they ran to the other in February when the Fed went hawkish, going from expecting rate cuts in sort of the January timeframe, and then in February it was those were all priced out, and the terminal rate was creeping towards 6%, and the fire-breathing hawks on the FOMC were focused on the elevated non-farm payrolls and inflation figures. Flash forward a month, and it's completely the opposite. Everybody's running to the other side of the boat now, and pricing in real extremes of easing in a very short time frame. And you can just see that elevated volatility playing through into the Treasury markets. It's and Treasury market volatility, let's face it, was kind of a root cause of the Silicon Valley Bank trouble. So this is not a favorable circumstance.
The Fed was in a fairly precarious political situation just as a policymaker. Now it's also been highlighted they're also the regulator, and now they're the hot button issue. Do you think we could possibly see legislation in the future that changing the Fed mandate and things like that?
Yeah, I don't think they're going to be able to go that far. I think that the reality of getting consensus on the Hill is, the reality is that it's not a reality. You can't get consensus on the Hill between Republicans and Democrats right now. I think that what you're going to see is a lot of noise, and I think you're going to see a lot of noise from both sides. But beyond them agreeing to make the noise, I don't think they can agree on what the policy changes might be. We did see Tim Scott, the ranking Republican on the Senate Banking Committee, already send a letter over to the Fed. I believe Powell and Barr are named explicitly on it. They want all the documentation, all the investigations that the Fed has done into Silicon Valley Bank. I think going back all the way to 2019. So there's going to be rigorous oversight. Does that change the Fed's mandate? Does that change the Fed's focus? Powell actually has been one of the most politically savvy Fed chairs that we've seen in recent history. He spent a lot of time not just obviously testifying on Capitol Hill, but having those one-on-one closed-door meetings with lawmakers exactly before any problems arise. So he has that kind of foundational relationship. So I think there's going to be a lot of oversight, a lot of noise, but I don't think this is going to change the Fed's mandate at all. And with that actually might be a great place to stop, because we're going to talk a lot more about the potential regulation coming out of Washington, or potential for legislation, not just around the Fed, but also around the banking sector during the next part of our podcast. Stay tuned.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
Well, Federal Reserve Chair Jay Powell was not the only one making news this week. His predecessor and now Treasury Secretary Janet Yellen also testified on Capitol Hill. Normally, this hearing is not as exciting as a Fed press conference, but she did make a little bit of news during her testimony, namely when she talked about the possibility of either increasing deposit insurance for the banking industry, or the possibility of universal deposit insurance. What she said was, this is not something that we had looked at, and that the Treasury has not in any way discussed the possibility of blanket coverage. So that seemed to be at odds with what Fed Chair Powell said during his press conference. Brendan, can you help us make any sense of this?
This was a very good advertisement for Penta Group and why communications really do matter.
Love the plug. Love the plug.
Good. Yeah, nice plug.
You literally had Powell testify at his press conference saying, we're not going to do something specific right now, but we will do whatever it takes to protect the banking system. And the market took that very well. And then you have Yellen up on Capitol Hill, who basically said the exact opposite. It's like, we're not even looking at that, and the market sold off. And then she went back up to Capitol Hill. I think she was on the Senate the day before, and then went to the House. And usually you deliver the exact same speech, and she changed her speech to say, we will do whatever it takes. And you don't have to say, we don't need to protect every deposit. There actually is a private solution for this. You can insure your deposits up to $150 million. Costs you 13 basis points. There's a group here in DC that does it. They mix it through a bunch of different banks. So it's not like if you're a company and you have $10 million to pay in your payroll, that if you're worried about your bank, you can protect it. It's not the end of the world. But we just need to know that our policymakers are aware that we're not going to allow a huge bank run and the entire implosion of our banking system. And I think they finally got that message out. But the market reaction today, banks are down again, and now it's seeping over to Europe also. Deutsche Bank's down, and their bonds are selling off. So I think policymakers have not done a very good job of communicating exactly what they're doing and why they're doing it.
I guess my question though is, yes, we know that there is a government backstop, that the Fed, Treasury, FDIC, everyone will jump in and shut down a huge bank run. But what about a mini bank run? Or what about a small bank run? Because I guess part of the issue here is that Silicon Valley Bank wasn't supposed to be the catalyst for anything, right? It should have been able to just fail and not have these ripple effects that could potentially force the Fed to cut rates in the second half of the year, right? So where is the threshold? And I guess that's part of what maybe regulators are trying to get at with this debate over what size bank actually needs a tighter level of supervision. But if we're in an era where any bank run can cause the public to panic and can take off on social media and go viral, does that mean that every bank needs a government backstop?
Yeah. And John, I think your background at Treasury is insightful here. Like, what are they doing over there now?
Well, we just got a headline that Secretary Yellen is convening the let's see here. I don't want to misquote. Is convening a private meeting of the Financial Stability Oversight Council this morning, and these are the kind of internal meetings and processes. It's a government agency. It's driven by process. And so when you have the Treasury Secretary convening a meeting of FSOC and bringing in the leadership from other parts of the Treasury for sure to sit down and essentially do a war room exercise, where you're getting the state of play and then you're playing out various scenarios and trying to array your policy options, based on the different gradations of severity of what you're going to see next. And, they obviously have a significant amount of, they have a significant amount of tools already deployed, right? And in conjunction with the Fed. And so I think it's going to be a question of, talking about messaging, talking about, other fail-safe exercises. It would be great if there was some sort of resolution for First Republic Bank. That's been
that's a really important point, because I'm kind of amazed that First Republic isn't solved yet. Jamie Dimon so the American Bankers Association had their big meeting here. So basically all the CEOs of all the major banks were here, and the CEO of JP Morgan was really trying to find a private sector solution for that. And what's kind of leaked out is apparently their balance sheet is bad enough that unless there's some sort of government kind of guarantee or backstop, no one's particularly interested in buying it. So that is definitely troubling that we haven't solved that one yet.
Yeah, and I think there's got to be some sort of resolution on that sooner rather than later. You don't want this to. It seemed as though earlier this week things had calmed down pretty substantially in the U.S. In U.S. banks and regional banks, but you just don't want, and Europe then had their wobbles. You just don't want this to re-intensify again, and to have as many solutions, and also be preparing the U.S. banking system for an accident in Europe. Sadly, that's the reality, because of the massive complexity and much more challenging policy landscape. When you look at Europe, they don't have the same degree of unity on the policymaking side. You've got a lot of different voices around the table, and so it's something that surely they're factoring into their risk calculus and scenario analysis.
Yeah, and we talked about banks not making loans going forward, but more troubling, we haven't had a high grade debt issuance in over 2 weeks. So the bond market is completely frozen, and that's very troubling.
Okay, so I will admit, one thing that has always confused me is the bond market. I know that there have been wild switch. The the 2-year Treasury is up, 2-year Treasury is down. What's going on there? And I guess what is that signaling about what the markets think the trajectory of the economy might be?
It is blaring a warning sign. Is what it's doing.
I know there's a sign. Yeah. I just don't know what it's saying.
Yes, as you mentioned, the volatility in and of itself is very worrying, and it is that dynamic of the neck snapping changes in the outlook from that were driven by very weak December, and then big upside surprises in January, and then the banking crisis that began in March. And so we've just seen the bond market getting whipsawed in very significant ways. But as we discussed before, the significant declines. I mean, the 2-year Treasury yield was like around 5%. It's 3.65 this morning. I mean, it has absolutely plummeted. And the 10-year Treasury yield is down less, but is at 3.3. 2%. These are way off their highs from just, a month ago. And this is, essentially portending a very weak economic outlook. The Treasury yield curve, which is the recession indicator, has been so deeply inverted. It was the most negative it had been since 1981. Well, it's steepening now, but that is, typically the inversion precedes a recession, and the yield curve steepens into that recession. And so that's the dynamic that the markets are pricing in now. With the 2-year coming down, front end rates are driven by policy expectations, and policy expectations are for a historically fast pivot to rate cuts right now. Our view is that the bar to cut rates is going to be a lot higher than the market currently thinks. And we think that that's going to be a source of potential disappointment and volatility that the Fed really needs to manage. Chair Powell tried to do that in his press conference. He said, we're not, he obviously left himself some wiggle room, but basically said, no one on the committee sees us cutting rates this year under any of our, sort of basic baseline assumptions. And the market just took that and threw it in the trash, and is pricing in essentially a whole percentage point of cuts by December.
Yeah, and in times of stress, the government bond yields go down. So it's actually, the government can issue debt very easily and actually at a lower cost, but private companies have a harder time. Even though the Treasury yields are coming down, they're coming down because we're going to recession. So even a company like Microsoft has not issued debt in the last two weeks, and that's very, very troubling.
Yeah, Powell said explicitly that rate cuts are not in their base case, but as you said, markets don't seem to believe him. If we continue to get strong labor market data, if we continue to see, maybe a slight slowdown in inflation, maybe best case, is that belief of the bond market still hold, or is everyone just betting that the financial conditions, the credit markets, et cetera, will tighten up so dramatically that is what's really going to undermine the ongoing strength of the economy?
Yeah, the bond market's telling the Fed that you're looking in the rearview mirror and we're looking out the windshield.
And that's part of what we're seeing. Economic data came in. Like, for instance, we got this purchasing managers indexes from Europe this morning. They look pretty good, and no one cares, right? Because everyone's like, okay, that was March, right? And everything's different. So the dynamic, obviously, on a going forward basis, if we start getting into the summer, and when the markets right now are envisioning a massive deterioration in economic conditions, and that's not happening in the data. Well, we've seen the markets really be wrong-footed and off balance and rushing to the next. Each data point seems to create its own gravitational pull in the bond markets, and Fed commentary playing off of that. So it's certainly possible, as you say, that it doesn't feed through to the data. And Chair Powell said that himself. He said, maybe we won't see it. Who knows? Right. And this is a very, very thick fog of uncertainty that the Fed and markets are sailing into here.
Well, next week we should be getting a few more beacons of light of data, perhaps in the fog of uncertainty. We've got Case-Shiller home prices, PCE will be coming out next week. Brendan, what are you paying attention to?
So it's a little slower week, but we do get the Fed's preferred price measure, the PCE price index, at the end of the week, along with personal income and spending. So that's kind of the biggest data point of the week. The last month, well, it was February, but that measure came in above market expectations, which that's what got the market repriced to, we're going to go to 6% on the Fed funds. And then in the meantime, we've had a banking crisis. So this data is definitely very, very backward looking. But the Fed has very much, tied their, fate to the inflation figures that come out. So we'll see what that prints.
Great. Also happening next week, Michael Barr, the Fed's Vice Chair for Supervision, will be testifying on Capitol Hill. So I'm sure there'll be a lot more banking news to discuss, a lot more fallout to talk about in next week's episode of the Macrocast, but we'll leave it there for now. Thank you so much for listening. I'm Ylan Mui with Penta, again, joined with John and Brendan from Markets Policy Partners. Please remember to like and subscribe to the Penta Podcast channel wherever you listen to your podcasts. And everyone, have a great weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.